people are like asking us, like, how many B2B SaaS businesses can there be in the world? My answer is always like, 100 times as many as there is now.
Why is that? Where do you see the opportunity?
Well, I think like just talk to someone who has a normal job, and like ask them like, hey, how's your day-to-day interfacing with computers?
Your workflow,
Yeah, and then they'll just start telling you how terrible this giant bit of software they have. It doesn't work. It doesn't do this. It's awful.
Or that they manage everything in a spreadsheet.
It's all Excel or like fuck computers, like that sort of thing.
Ignition sequence start. 3, 2, 1.
Einar Vollset. What's up, dude? Appreciate you coming on, man.
Sure thing.
So those that don't know you, YC alum, sold your company to Google, did another company, exited that, Discretion
Flower
Capital,
TinySeed.
flower farm owner.
I own a tractor.
2
dogs.
Chill. Where at again?
Santa Cruz Mountains.
Santa Cruz Mountain. Sounds super stressful.
Sounds hard.
sounds hard. And startup-y guy. Partners are involved in the TinySeed fund with Rob Walling.
Yeah, it's me and Rob. Yeah,
you and Rob, and then MicroConf fan. OG man in the space.
I feel old.
What do you see as kind of like the fun stuff in the SaaS space? That's keeping you busy. What's interesting to you?
To me, the most interesting thing is the number of companies starting. Like it's always like. I was always flabbergasted, like it's particularly in the B2B space. It's like I'm always flabbergasted at how much money you can make in tiny niches and how much bad software there is out there that people and companies are fixing. I mean, that's essentially a big part of the thesis with TinySeed is like, there should be like one of my friends runs a kitchen countertop installer software company, and the first time I met him, I was actually a bit of an asshole as usual.
Kitchen countertop installing, so service business.
No. You don't get it. Like you have to listen to the whole sentence.
Wow.
Kitchen countertop installer software.
So if I didn't hear that last part.
Yeah. It's software for kitchen countertop installers. So it's a great business. Hi, by the way. And the first time I spoke to him was actually at MicroConf. I was like, oh, yeah, I'm sure that's a nice whatever business.
Cool.
Whatever. It's fun. Whatever. Yeah,
sounds fun.
And then I ran into him again like a year or two later, and I was like, hey, are you still doing that kitchen installer? And he's like, yeah. And then he told me what it's doing, and I was suitably humbled.
Those are always good.
I was like, damn, like his partner drives a 911, put it that way.
Yeah.
But I feel like people are like asking us, like, how many B2B SaaS businesses can there be in the world? My answer is always like, 100 times as many as there is now.
Why is that? Where do you see the opportunity?
Well, I think like just talk to someone who has a normal job, and like ask them like, hey, how's your day-to-day interfacing with computers?
Your workflow,
yeah, and then they'll just start telling you how terrible this giant bit of software they have. It doesn't work. It doesn't do this. It's awful.
Or that they manage everything in a spreadsheet.
It's all Excel or like fuck computers, like that sort of thing.
Yeah.
And so I just think there's a huge amount there, and in a way that like, the big things like Dropbox, HubSpot, sure, those are exciting and they're big, but there's just like this, it's not even a long tail, it's like the fat tail of products that can come out there. I think it'll be, I'm sure, it's sort of seeing it now, it'll be amazing.
And then what about the liquidity on the back end? You're seeing this with your fund, and you did some due diligence for a lot of PE firms.
Yeah, and the M&A work for Discretion. Basically, so what seems to have been happening the last, I'm going to say like 5 years, is that there's an awful lot of institutional money moving down market. So I was at a private equity sort of lead gen conference, actually here in New York City, a year and a half ago. And someone did a slide, and it was like, oh, the amount of dry powder, as in like committed capital to private equity, but not actually deployed, doubled. Yeah. Like it doubled.
What, in a 12-month period?
No, the last 5 years.
5 years.
That's
2x. There ain't 2x as many SaaS companies.
No, but what I mean is these guys are not historically buying SaaS companies.
Oh, okay.
And typically there'd be some, and they'd come to me like, hey, let me know when there's anything above 10 million revenue, like And now those same guys are like, we have this project, maybe we'd look at a $2 million business.
Yeah.
And so there's just an awful lot of money institutional money realizing that, you know, particularly a B2B SaaS model with a recurring revenue is an amazing like business model. Like
annuity.
I have private equity friends, and like I tell them like, oh yeah, like you know, I'm selling this $2 million B2B SaaS business, and yeah, like the gross margin's 90% and the net margin, the EBITDA is 30 or 40, and they just can't believe it. You know, they're buying and selling, you know, industrial manufacturing or pipe bending businesses or whatever, and they don't believe me. Like I've been called the liars. There's no businesses like that. I'm like, no, look, and it's all recurring, by the way, as well. And so I think the smart money on the institutional side is starting to realize like what, you know, you and me and this community has realized for a long time, that this is an amazing business model. And so that's why, you know, like 5-10 years ago, if you had a $2 million B2B SaaS business,
Good luck trying to find a buyer.
yeah, it's hard to sell, and like you have maybe 1 or 2 buyers. You pick up 3, maybe 4 times, like seller discretionary.
Yeah.
And now people are talking revenue multiples.
Yeah.
Like it's just across the board. And I think in part that's a smart money, like on the LP side and institutional investors, and in part that's because of just leverage. Like you see it now. Like I was on the panel with, you know, Timia Capital and their SaaS Capital, Lida Capital, all these people. Well, it's the same investors behind those guys.
So they're just getting part of the whole stack.
Right.
Yeah.
The same investor behind this, the same risk profile. If anything, it's a little less risky to provide
sure.
that kind of leverage to buyout firms buying fully controlling the firms.
Yeah.
So that's what's
You
happening.
think it's less risk to buy the asset than to finance?
I think so, because then, like, if you're providing leverage to a buyout fund, then you're the first line, right? If something goes wrong, like you liquidate, and like the person with the leverage, they get paid
They're
first.
first paid,
Like the equity guys get wiped out, but the debt guys don't.
Yeah.
So yeah, I think so.
And what's the thesis for TinySeed? I mean, the name in some ways gives it away, but you know, how do you guys think of that?
Well, the way, I mean, I
asset
have
class.
investors who both hate and some that love this explanation, but the way that I think about it is, it's like Y Combinator for non-unicorns.
Yeah.
So when I did YC, like in 09, like, and by then it'd become a thing, but like 05 or 6, like when Y Combinator was getting started, when, you know, people like First Round was getting started, there really wasn't a hole in the market. Like you couldn't, if you wanted to raise
Super Angel ish. Yeah.
Yeah, there was people coming along, and like if you had to basically have like a Harvard MBA and like a big business plan and do all this stuff, and what YC did was they came along and they said, you don't need any of that, please no MBAs. Just like we'll give a little bit of money to 2-3 dudes and then get them to where they can raise money.
Yeah.
And that really, I mean, look at them now. They're, like I said, 300 companies a year or something crazy.
It's just a machine.
Exactly. And so we think that TinySeed will fill that same market, but for companies that are, you know, probably
Don't
not going to
require-
IPO.
yeah.
Well, they're not going to IPO.
Yeah.
Like, so, like I said, the kitchen countertop installer software.
Yeah.
It's not going to IPO. Why would it? It doesn't make any sense.
Yeah, it's just a great cash
But
flow
it can
and
still be
asset.
an amazing business because of the nature of the underlying business model.
Yeah.
And we think like, and there are ways for these companies now to get funded, but it's a little bit like what YC was like. It's like, you know, there's some angels, some good, some bad. You know, and there are some people who are able to get a hold of capital because they pretend like they're going to IPO, but they know in their heart of hearts they're not.
Yeah.
And so that's essentially our thesis: is like, can we provide like a platform where, if you're building this kind of a B2B SaaS business, but you don't want to like sell your soul, work 100 hours, and try to shoot for the moon, you'd be perfectly happy to have a $20 million ARR business that throws off, you know, 30 to 50% free cash flow. That's
What's the structure?
Structure is
Or as a
equity,
founder?
basically.
Yeah.
We looked at it. There's some other people
But
in
is
the
there
space.
is there some level of expectation for, you know, distributions?
Yeah. So we basically say the way we've done it is, and we're sort of, there are other people in this space, like probably most well known is Indy.
Okay.
Bryce Roberts.
Yeah, that's Bryce.
Is sort of a pioneer in the space.
Yeah.
We think of them as a little bit later stage than us, although Bryce will kick my ass for saying that.
Yeah.
But yeah, like essentially what we did was we adopted very similar terms to what Rand Fishkin did with SparkToro. We essentially say like, okay, you know, we'll take an equity piece and we'll cap your salary at some reasonable number, like an engineer's, you know, like in the largest, closest large city. And we say above that, like for you and the key execs, like you have to kick out dividends, and we participate pro rata in those dividends. Yeah, I mean, that's
It's a neat model, man. I'm just fascinated with the different
It took
ways.
a lot of time to think about.
Yeah, but
actually.
it's
like
just,
it's hard to do.
cool because there's different options now to founders, like revenue-based financing, the lighter capitals of the world, the TinySeed. The VC seems to have gotten a little bit more value add than just, coming in and, there's the spray and pray models of the 500 startups. I mean, it's just neat to see this, over the last 10 years, really, the amount of innovation on the financial instrumentation. Because in other industries, this is just how it, the private equity guys have been figuring out how to slice.
They've been doing random stuff for forever. I mean, essentially what we're trying to do is to say, okay, like venture is great. Like if you're trying to build
there's just optionality now for founders.
If you're a Tesla or SpaceX or you're trying to shoot for the moon, great. There's plenty of that capital around. But if what you're wanting to do is, like I said, build a $20 million SaaS business, then we think our model is as good. If not better.
Most people watching 2 million, trying to get to 10. Bootstrapped, non-coastal cities, Utah for some reason. I don't know what's in the water in Utah, but
something.
Yeah, there's something. A lot of really great founders there, but and I love the fact that now if they're like, hey, we've got this engine, we want to invest in it, we can do some debt financing, and it's fair, it's not ridiculous. There's no back in the day there was a handful of players that were sometimes their terms were ridiculous with warrant coverage and like personal, like you'd lose your house if you crashed your business, which is like, come on, what are we doing here? Yeah, there's a risk assumed there. What kind of companies? I mean, you already mentioned kind of these like non-sexy, won't be covered on TechCrunch kind of fun. But where do you think the opportunity lies in the different stack of a corporate workflow? Like, what's the?
I think it's all over. Like I think. I don't even pretend like we had applications. We stopped taking them for the first cohort now middle of February, and I think we got nearly 900 applications.
That's amazing.
And it was just fascinating, just looking through the sort of applications and be like, oh, really? You're doing that much money, and that's in that peculiar niche. Yeah. And I I wouldn't pretend to say like, oh, it should be, finance, or it should be kitchen countertop installers or whatever. But I think it's a wide set. But the way that I think about portfolio construction and how we want to position ourselves, I think we want a mix of companies that are like my friend Nathan Barry's, which like ConvertKit, which is sort of a tech that can go across industries.
Just had him on the show.
He's a good-looking guy. What can I say? Yeah. And then
brings the viewers, brings all the viewers to the yard. He's not the front. I embarrassed him. I was like, "Hey, man, not bad, bro."
There you go. Yeah. There's that, and then but we also like the sort of more traditional on the higher end. Like this is what private equity tends to buy, the holding companies, which are more like, oh, I'm dominating this particular niche. It becomes like the be-all and end-all. Yeah. In part because it's just easier. Like customer acquisition is easier, churn's lower. Like and it's harder to dislodge, and you're not, you're at a slightly less risk of being like disrupted or priced out of the market by a super well-funded venture-funded competitor. Yeah. So that's those are the two things.
Do you see anybody doing like, because in the traditional PE kind of retail brick and mortar, they do these roll-ups. Yeah. But have you seen anybody in the SaaS space do that? And what kind of things are they putting together to make it work? Is it? It's shared customer segments and then trying to cross-sell to other solutions, or what are they buying?
So certainly that I think happens. I don't think it happens as much as I think it will.
I just haven't seen it done. I don't know.
I've seen it done a little bit. Typically, the sort of big player in the space is like Constellation Software, and like they're Harris and whatever. Yeah. I think I haven't seen too many of them, but interestingly. It's not necessarily like super related. Like you do a traditional roll-up, it's like, oh, I'm buying dentist offices in Indiana, and then just like more and more, and they're exactly the same.
Production.
Yeah, for like a B2B SaaS thing, I think the interesting thing is that the back end is very similar. Like everybody needs figuring out paid acquisition. Everybody needs to figure out SEO. Everybody needs to figure out, HR, whatever. The actual, and everybody needs, disaster recovery and backup and blah, 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 blah.
The back office can be shared.
Right. And so what I have seen are people buying companies. And so if you go below like $1 million ARR, there are still deals to be had. Like, in terms of, you're not necessarily
Who's buying?
Individuals are buying. A fair amount of like these holding companies are putting together.
Really? They're building their own teams to manage the technical side, and
they hire. A lot of them are like just contractors they have all over the place in some cases. In some cases, there's a big one out. For some reason, it all seems to be in San Antonio. Like there's a bunch of the old Rackspace guys are doing it. You know, there's a bunch of these holding companies that their whole shtick is like, we want to go and buy, you know, B2B SaaS businesses. We actually don't care that much about the industry, but we're going to centralize, like centralize actually engineering in some cases, and then just sort of plug these things on. And if they can do cross-sell, great, but they don't actually need to, I think.
They don't care.
No.
I don't know, man. I'm just such a product guy that I just can't understand how anything great will continue to happen to the product from a product. You know what I mean? Like innovation.
But I think about private equity, right? You know, like it's not about this.
Yeah.
Like you're the guy who wants to do the product thing for the next thing and 10x it in 18 months.
Yeah.
These guys are like, if they keep it steady and improve the
don't
margins
break it.
slightly, particularly if they have leverage on it, it's cash flow. Like who do they care? Like the main thing for some of these guys is like, is it uncorrelated to the general market? In which case, yay, I can get $500 million to buy a fund to do it, you know? So
that's neat. And what do you think that a lot of the founders, what's going to draw them to decide to take one, you know, when the money all looks, you know, it's all green.
Sure.
What do you think the value adds are becoming important to the funds to have to demonstrate to a founder that decides to?
I mean, I think like how we position TinySeed is that it's just like it's new. You know, it's early stage. We're taking, you know, usually sub 20,000 MRR, and we're specifically going after companies that are saying like do not have a story that includes, and then we IPO in 2 years. Like I think at least initially that like our positioning will be unique from that perspective.
Yeah.
I don't think anyone else is doing that right.
And the capital typically goes to marketing or
Typically
engineering?
no. Like typically it's actually so early stage. Like, you know, it's like our sweet spot's like 2,500 to 10,000 MRR. And sort of, it's actually like, it's funny, I was sharing the deck with your boy Nathan, and he was laughing because his name is all over the pitch deck, because essentially what he did with, I don't know whether he's actually shared that on the interview, but like, you know, he was doing ConvertKit. It was just, you know, this thing he launched, and it was, I mean, I was a customer like back in the day when it was doing nothing. It was awful. It's an awful product.
Yeah.
It's terrible, unusable.
Well, he said he bounced at like 2K.
Yeah, like 2,000-3,000, like for
yeah.
several years.
Yeah.
You know, and then actually one of our he's been super helpful. One of our mentors, Heaton Shaw, was like told him like, dude, either shoot this in the head or make it the thing.
Yeah.
And he took some capital. I think he had some money from his info product stuff, and said, all right, I'm gonna make it the thing. Yeah. And he went from like 3,000 MRR to 64,000 MRR in a year, and now he's doing, I don't know, like a bazillion,
yeah.
like, you know, he's got so much money. He's like, you know,
yeah.
But
building tiny houses.
Yeah, exactly. He's still got his Airbnb apparently.
Yeah.
It's good for him.
Yeah. He's diversifying into real estate, building tiny homes.
Exactly. So that's sort of the thing. And what ended up happening is like, I pitched this to Rob, and Rob sort of was like, dude, I've had this, you know, it's a thing in my notebook since like 2011. Like we should do like a YC for this. And yeah, I think, you know, like we kept seeing this pattern over and over again. Like people in the community, like they'd build something, they'd launch something because they saw a need. Either it was, you know, a custom thing they'd already sold to a customer. They're like, oh, there's got to be lots of people like you. Or it's like they're scratching their own itch and they build it and launch it and it gets to a certain stage. But, you know, in most places, if you're making 3,000 MRR, it's not going to pay the rent.
No.
So then you have to be like, okay, well, I'm going to go back and I'm going to do, you know, like a 3-month consulting gig. And then you come back 3 months later and your business isn't shittier than it was. And never really goes anywhere. But if they take just a little bit of money, like either usually like, you know, friends and family or just savings, if they can make it the main thing for like an extended period of time, then
it can become
they can take off. So our goal essentially is like, we do a cohort, it's like a year long, fully remote. And basically, we're simulating the fact that 1 or 2 founders get to
focus on it,
make enough money to sort of do it for a year.
And essentially, you provide the infrastructure from an acceleration point of view to give them some thoughts on positioning.
Yeah, so
marketing.
we have a ludicrous amount of stupidly talented mentors.
Totally.
You know, who are excited about helping, and that's a big part of it. And we'll do like you know, 2 or 3 in-person retreats to get people together. We'll do like bi-weekly or weekly sort of mastermind type calls. At least that's the plan, I guess.
Yeah.
I guess we'll see.
Still early days.
It's early days, yeah.
And do you think any of the guys like the, you know, the Vistas, I mean, they're probably buying such a later stage company.
They are typically, yeah.
That, you know, the CEOs, it's really just, you know, they're trying to get the best price and they don't care so much about how the asset or the company's treated after acquisition. But I mean, you know, like, how are they competing for deals, or is it just purely who's going to pay the most?
On the buy side,
Yeah.
you mean, for later stage?
Yeah. Because I mean, there's deal flow, and then there's like, if you get founder and you've got optionality, I think more and more. I don't know personally, like I want to. My last exit, I chose the acquirer that I felt was gonna do right best, for the community that we built and the customers that we built, and not fuck it up.
Well, I think it depends. Like, to a degree, it depends on the founder personality. Some founders really care about what happens, with the community thing and like with their customers and employees. I think pretty much
I thought I read
universally people care
Is there? I forget the name of the company, but I think he's an old Trilogy guy, and he buys companies and just slices out the engineering. Did you hear about this?
Yeah, that's the guy out in Texas.
Yeah, another Texas guy.
Another Texas guy.
Yeah, and it was like, they essentially, I think he bought, a company in Portland. They had about 300 engineers. They fire everybody. I mean, that's his model. He essentially like optimized for profitability. And I'm just like, okay, that's a way to make money. It's just, who's selling their businesses to these guys?
So I think the people, without sort of bad-mouthing anyone, I think the people who... Nobody listening.
Yeah, there's nobody listening.
Just the two
just
of us
between you and I.
That guy.
Yeah.
And it's
Ignore
like,
the microphones.
It's just, I really like to have this big
you
black
have
thing
phallic-looking
right in
thing
mouth.
in my face.
Oh, I think I'm going to connect something. Anyway, I think those guys are buying on the downside. So you have to understand, like you can get 3, 4, 5x quite easily revenue-wise if you're growing and it's on the up and there's a story. The second you have a year where it's like a downward slope, the number of buyers goes away. I think in part that's a leverage thing. Like the lenders will turn around and say, I'm not going to give you as much leverage because you didn't do that. So if you're down, 15%, even from a pretty healthy growth rate the previous years, the number of buyers fall away pretty quickly.
Yeah.
And I think those guys are like, I wouldn't exactly call it distressed assets, but it's certainly like, they don't, like, if you go to someone like that, they don't pay the highest multiples. They're more like, their whole shtick is like, okay, do we understand the unit economics? You might be losing money. Like this
today, you're losing money.
Yeah, so the Portland company might be losing money with 300 engineers in Portland. Like the kombucha and things is expensive in Portland, I hear. Yeah. But like, and so you couldn't sell it on the EBITDA multiple. So then it's like, you got it, and they turn around and they can make a profit from it. That's, there's only so many people who can do that.
Yeah, they're willing to buy those kind of assets.
Yeah, so I mean, my piece of advice is like, have a profitable company that's growing when you want to sell it.
Yeah, crazy idea. Yeah,
things are easier in that case.
Yeah,
like it's a lot harder work to sell a company that's on the down or is
trying to explain that story.
It's like, we'll turn around like 6 months from now, but you should buy it before we actually check that.
Yeah, before we have that thing. What do you see? I mean, you've obviously been around a lot of strong founders, that are scaling, growing companies. The Nathans, ConvertKit, many others. What are you seeing them do right to make sure that they make, they continue to accelerate that growth?
I have no idea. I have no idea. Like, I think like a high growth business like ConvertKit, no idea. Like, I think usually what happens is, or anecdotally anyway, when I talk to people, it's like people try a bunch of different things. Like they try paid advertising, they try SEO, they try partnerships, they try influencer marketing, they try referral marketing, whatever they try, and then they find one channel that works just a shit ton better than everything else, and then they just throw all their money at that. And big companies can be doing that. Like, I did used to do due diligence work for private equity, and you'd see like a $50 to $100 million e-commerce company, and they had one thing that worked. Like it could be like Google Ads, like
but
all we care about, and like
well.
Yeah, the CEO could literally be like, all I care about is CPC. Like, what is the CPC? And I was like, like we fired that guy because the CPC went to 2.9 from 2.1, and I'd ask him questions like, but like, what is the actual cost of acquisition like here? Like, did it change? Did it improve? Maybe you're spending a little bit more money to convert a lot better. And he's just like, I don't know, but CPC needs to be under 2.5. And that's what he'd been working. That's how he got to the size he did. He was just throwing money at this one channel. I don't think that's necessarily the best in the world, but
it is a good. I mean, the strategy of not diluting your focus and doing 15 things, and if you find one, actually
find one that works. You don't know how it's going to work. It could be like a blip. And you might as well, put $100 in to get $500 back. It's good. It's a good business, I hear.
Yeah. And then what about the founders, like the TinySeed founders? Like, what if they I guess you have equity. At some point, there's an understanding that they'll be doing distributions, but I guess you want them to not do side projects, not do anything else. Yeah. So there's an understanding that this is now your primary
This is
thing.
a full-time thing. Like the whole pitch is like, we give you the money so that you can do it the full time. There are some people who come to us and say like, yeah, I have this thing and it's nearly full. Can I take some money and then like I still want to keep this like profitable side? But it's only 20 hours a week, and I'm like, no,
Doesn't
is
fit.
the answer. So we've turned that down so far for sure.
How many deals do you guys do?
We're gonna do 10 to 12 like next couple of weeks, and then we'll do another cohort this time next year, probably similar size, maybe a little bigger.
Yeah.
And then I'll be on the streets fundraising for fun too.
And do you think there's a lot of brokers out there that are do you think there's traditional guys that used to do they getting into the SaaS space? Like, is that growing in regards to the people
on
that
the
wanna-
M&A side, and the
Yeah.
sell side, you mean?
Yeah, on the sell side.
Yeah, I think there's more people moving in. I mean, part of the reason why discretion capital works is because we take the kind of deals that like a boutique, like your Lazard or whatever, wouldn't actually want to touch because they don't want to do anything less than $100 million enterprise value. It doesn't make any sense for them. Versus we can do like sub 20 million, no problem. Like partly because we wrote the tech to like not have to have 5 MBA students full time, working doing their thing. But I think, I mean, there hasn't been too much qualified competition in the space so far. But I mean, who knows?
So you guys with TinySeed fund, and then discretion capital will also represent them on a sell side transaction?
We haven't really decided. I think we probably will. I think the sort of structure we'll do, at least we'll give them. So one of my pet peeves in the sort of spaces, and this happens in Silicon Valley a bit, is like you have a company that maybe is venture funded, and it's a good company, but it's clearly not going to like be a big unicorn type thing. And so the VC just wants to get rid of it because they don't want to go to the board meetings. It's just a distraction.
Have that
whatever.
on the
And so they will say like, I just go to sell to that guy, or sell it for, and they end up selling it for a pittance, like 1x revenue.
Yeah.
Versus, like if they came to us, we could turn around, we could probably get them 3 or 4x revenue, which that's the difference between like, oh, I can afford to buy a used car, or I can afford to buy a house in the Bay Area.
Yeah.
So that's a big difference, I think.
And how do you think founders should evaluate? I realize I'm asking a butcher to answer what I should have for dinner, but
I think meat.
yeah. But how should a founder that has 80K MRR think about financing their growth? Like there's with these different options, like the equity versus the debt.
I don't know. Like 80K MRR would be bigger than we're currently doing with TinySeed. So you should take my advice 100%.
It is not.
I think it depends. Like I think, I can imagine scenarios where like, say the TinySeed companies, they get the end of the year.
But evaluate both, like, the other company mentioned earlier, like, you've got like those guys that are doing later stage, taking equity, but then, distribution or buyout their position. And if you don't want to sell, and then you've got like the lighter capitals that'll finance on MRR, like how should they think about those two options?
I think it's a personality thing. Like, we run into founders who are like, and I don't know why they apply to us or contact us just to tell us that they don't want our money and they would
So
never
funny,
sell
eh?
anything.
Yeah, they're like, we want to tell you no. We're gonna apply.
It's like, actually, I don't want your money. I'm like,
Yeah. Well, then why'd you apply?
I didn't force you to put your name in here. Like,
Yeah.
what happened?
Yeah.
And I think, some of those people are like, I don't want to give it like an inch. Like, I don't want to give anything whatsoever back to my company. I just want to own it 100%, in which case, like, do that. And like, if you're of a certain size, I think 80K, you're probably in an odd spot. But say you get to 100, then, like, lighter capital, Timio capital, it's a good thing. I mean, what I'd be wary with some of them, and I'm not going to name any names in there, is that some of them actually, you should make sure that they don't actually take personal guarantees. Like some of them do.
Yeah.
Like somewhere in their terms, it's like, if you don't
fine
do this.
print.
Yeah, and there are some, like this is partly the reason we ended with equity is like, it's pretty straightforward. Like we own 8% or 12% of your company and
you own the
done.
rest, yeah.
Like versus some of the more sort of finicky documents are like
financial
you sort of have
engineering.
you have to work out like, oh well, what happens if in this case and I haven't done that, and all of a sudden it's like, well, how come you own 28% of my company?
Why is this backed by mortgage-backed securities?
Yeah, exactly. So I think that's the thing to look at with the actual thing, and actually like understand like what things are you actually signing up for, because in the debt products it's not so nice and not so easy necessarily. And I think like a lot of them are like in there are scenarios where like
and are these like some of these debt product, like back in the day I almost felt like some of these companies were almost like lead gen for the distressed asset buyers. Like, you know what I mean? It's almost like they didn't want to get paid.
yeah, I don't think that's the case. Like,
No,
I think
it's a lot better today.
yeah, I think so, and I think like again that has to do with the fact that there's just a lot more money in the space.
Yeah, and more
like,
sophistication.
yeah, exactly.
Yeah,
And I think I think a lot of them are really good options. I think it's like play out in your head or with your CFO or whatever, is that what happens in a bunch of different scenarios. Like I think a lot of founders, particularly when they've had some success, are pretty convinced that things are just going to go the way they have been. And I would at least play out in Excel
what
to
does
say what
success look
happens
like?
if growth slows a little bit,
Yeah.
or like maybe growth tapers off.
Yeah.
And how does that play out? Like, because some of these firms are like dependent upon the growth of MRR or ARR, and if you're not growing as projected, they actually take a substantially larger chunk.
Yeah.
And like they start like turning the
Clawbacks.
screws.
Yeah.
Yeah, and it could get to the point where like they need to get now, because you are not as profitable, growing as fast, they need to get paid back quicker, which is a double whammy.
It's just gonna
right?
hurt you more.
Initially, you thought,
Yeah.
oh, I'll grow this, and then hey, I can add some fuel to the fire.
Yeah.
Now it's like, oh, you know what? We're not growing as fast naturally, and now I have to pay back quicker.
Yeah.
Like there is some of that things to be aware of.
Yeah.
But
especially
some
if you plan
people-
on doing some kind of financing and
Yeah.
now you can't do it.
Right, because you have debt things,
Yeah.
and it closes some doors. But I think, like, in terms to answer your question, I think that people, it's a personality thing more than anything else. Some people really want to own 100% of the company, or as much as they possibly can. They want, nothing. In which case, okay, then equity's off the table for you, which is great. Okay, you do
And
that.
if you want enough capital, you might have to personally guarantee some stuff.
Yeah, I mean that's just how the world works.
That's the
Turns
nature
out
of the
nobody gives you
business.
cash for free,
Yeah.
sadly.
What do you think of events like, some of these big SaaS events where everybody, you mentioned you weren't going to a lot of events. We're here in New York at LTV Conf, a lot of SaaSy people. Is it frothy in the market right now for SaaS? Do you think the correction's coming soon and people are going to be a little bit more, less optimistic? Because, I mean, the valuation, it's weird. Even on the owner side that are selling, I mean, their expectations are pretty high. Like, I'm like, it's, I'm not buying at that price. You know what I mean?
No,
Like,
I mean it's crazy. I talked to several people on the sort of holding fund side, and they're like, yeah, when we started, I thought we could do like 4 to 6x revenue or 4 to 6x EBITDA, and I'm like, yeah, no, not for like, you can't buy a $2 million SaaS business for 4 to 6x EBITDA. Like,
Yeah.
But do I think it's frothy? No, I don't necessarily think so. I think it's more a realization of like, this is, given how churn works, given how the recurring revenue, the value of those cash streams, I think that's the value.
Yeah.
But like talking about the events, I was, I'm a big fan of MicroConf. Obviously, I quite like LTV for the first time I've been here.
Yeah, it's been great.
But like I went to SaaStr, which is only 25 minutes from my house. in
Somebody
San
called
Jose.
it the Tech Refugee for, what was it called? Because I guess the year before last, everybody was eating on the ground. Like,
Oh, okay. I didn't know that.
Like it was just like too many
Was it
people.
Fire
on a small-
Festival?
Yeah, it was like a fire festival.
Fire Festival. I thought it
Whatever.
was
I know. I'm not
Great.
bashing,
I watched
but
the Fire Festival commentary, the documentary, and I was like, this guy could be in Silicon Valley.
Yeah. How bad does he want? I need some water.
Exactly. Anyway, so yeah, no, I went to SaaStr. I think SaaStr is too big for me. It was so big. I was wandering around like, what the hell's going on here? And then, I didn't realize that there was a downstairs until day 2 or something. And like I went to the downstairs one, and actually like this is we're in a reasonably sized room here, but it was the small rooms, the talks were tactical and helpful and stuff. Whereas the big rooms, it was like, it's pretty clear. It's like one sponsor was talking to another sponsor about how great they were.
Yeah.
And I was like, why is there 500 seats here to listen to this? Because I don't need to know that so-and-so cloud was really facilitated the transition to the cloud to Acme Corp. Like, the fuck do I care?
Yeah.
And I think that was the main complaint. And and this is sort of a pet peeve. Not a peeve, I guess. Like, you go to SaaStr, and like there was a lot of companies paying for booths and things, but they weren't companies selling to other SaaS companies.
So why were they there?
Yeah, like what the hell are you
Optics?
doing? I don't know. I guess they got to spend their marketing budget on something.
Yeah.
'Cause it was that was weird to me, but
That is weird.
yeah.
Yeah, I mean that in some ways that just shows how the market is. It's kind of people are excited and they're just doing stuff to stay busy, but not measuring.
Gotta spend the money somewhere.
Yeah, no, I just find it super fun. I mean, I get to talk to a lot of bootstrap founders, and the best ones I feel are just like heads down executing, and when they come up for air, they're looking for tactical stuff, to add to their quiver. Interesting question that I like to ask is, as an investor and somebody that's involved in kind of like the due diligence side, what are the skills that you had to learn to kind of to be good at what you do?
I mean, it still remains to be seen if I'm good at what I do.
Yeah. Early days.
The early days. Like on the M&A side, I think actually a guy I have a lot of respect for is Justin Kahn.
Yeah, I know Justin well. Yeah, we just had dinner.
He's the guy. I remember him from the YC
Justin
days
TV.
when he was walking around with this thing.
Now he's doing Atrium.
Exactly.
In the VC space. Yeah.
Which is like lawyer space, which is like
lawyer, yes.
Yeah, and it's like essentially what he does with Atrium as a play is to say there's a lot of stuff here that's busy work, and then we can sort of have tech in place in order to do that. And it was looking at that is what made me start. Once people came out of the woodwork and it's like, hey, private equity and things, like I've got this business, can you look around for me? It was that which sort of influenced sort of my decision to start building like the tech part of that. And I think we have and what ended up happening was I built this system that essentially says, okay, you have this company does XYZ. Who should buy it? I mean, that's essentially the problem of M&A. Who would pay the most for it? Like, if you can,
the strategic buyer.
No, not even necessarily that, but just like if you have a company that you want to sell, if you as an investment banker can guarantee that you can find the person willing to pay the most, then you're a great investment banker.
Yeah, that's your job.
So how do you do that? And traditionally, you would do that by just hiring a bunch of MBAs as associates, giving them access to exactly the same databases
everybody else has.
They spend 3 weeks and just go through and just cold email people.
Yeah.
So I wrote some tech that essentially without going into too much detail, essentially says I can figure out which private equity, family offices, strategic acquirers to a degree, have active portfolio companies where this specific company would be a good fit, and this is the person who did the loudest deal. His is his name. That's essentially
sounds like it could be valuable.
Well, so here's the thing. The funny thing is, I was like, oh, this should be a thing. Like, I should go.
Yeah.
So I called a bunch of like this sort of boutique investment guys, and they're like, yeah, I don't know that I would pay. Maybe I'd pay $200 a month for this. And I was like, this is far too valuable for $200 a month. Yeah. I was like, and I don't know. Actually, don't know how well it works outside of like my subfield of like tech-enabled services, B2B SaaS. I don't know if it will work for like plum or roll-ups in the Midwest or something.
But for what you do,
it works pretty well. It means I don't have to pay 3 MBAs who have giant student loans.
The tech can take care of it.
Yep.
Einar, where can people find you online?
Check out TinySeed.com or Discretion Capital, or I'm extremely quiet on Twitter at Einar Vollset.
Cool. So tweet at your Twitter.
Do it.
Awesome. Really appreciate you being on the show.
All right, thank you.
Thanks so much.
Ooh.
Boom.
Thanks for watching this episode of Escape Velocity. Be sure to like and subscribe and leave a comment with your biggest insight from our conversation. Be sure to check out the next episode.